Reducing capital gains tax in India, effective strategies for tax savings. Subscribe my channel. Capital gains tax plays a vital role in India's taxation system, particularly when you sell certain assets and generate profits. However, there exist several legitimate approaches that can be employed to minimize your capital gains tax. In this article, we will delve into different scenarios and provide practical examples to help you grasp how you can effectively reduce your tax liability. Long-term capital gains, LTCG. Scenario: selling stocks after holding for more than 1 year. Example: let's consider the case of Rahul, who acquired 500 shares of XYZ Limited in January 2019 at 100 rupees per share. In February 2021, he sold these shares at 200 rupees per share, resulting in a gain of 50,000 rupees. A. Leveraging Section 54 EC, Rahul can invest the capital gains, up to 50 rupees lakhs, in specified bonds issued by NHAI or REC within 6 months. This enables him to save taxes on LTCG. It's important to note that this exemption is available only once in 3 years. B. Opting for Section 54F. Another option available to Rahul is to invest the entire sale proceeds, not just the capital gains, in a residential property within 2 years or construct a property within 3 years. By doing so, he can claim exemption under Section 54F. Short-term capital gains, STCG. Scenario: selling property within 3 years of purchase. Example: let's take the case of Meera, who purchased a residential property in April 2020 for 50 rupees lakhs. In September 2021, she sold it for 65 rupees lakhs, resulting in a gain of 15 rupees lakhs. A. Offsetting with STCG losses. Meera can offset any short-term capital losses, STCL, incurred in other assets during the financial year against her STCG. This will effectively reduce her taxable income and consequently, her tax liability. B. Reinvesting in a residential property. Meera has the option to reinvest the entire capital gains within 2 years or construct a residential property within 3 years. By doing so, she becomes eligible for exemption under Section 54. Capital gains from mutual funds. Scenario: redeeming mutual fund investments. Example: let's consider the case of Aman, who invested in an equity mutual fund scheme in January 2018. In May 2021, he decided to redeem his investment, resulting in a long-term capital gain of 2 rupees lakhs. A. Opting for Section 54 EC bonds. Aman can invest the capital gains, up to 50 rupees lakhs, within 6 months in specified bonds, allowing him to save on LTCG tax. B. Utilizing Section 54F. Alternatively, Aman can invest the entire sale proceeds, not just the capital gains, in a residential property within 2 years or construct a property within 3 years. This would enable him to claim exemption under Section 54F. Capital gains from selling gold. Scenario: selling gold jewelry or bullion. Example: let's examine the case of Sneha, who inherited gold jewelry worth 10 rupees lakhs from her grandmother. In October 2021, she sold it and realized a long-term capital gain of 2 rupees lakhs. A. Opting for Section 54F. Sneha can invest the entire sale proceeds in a residential property within 2 years or construct a property within 3 years. This would qualify her for exemption under Section 54F. B. Utilizing Section 54 EC bonds. Another alternative available to Sneha is to invest the capital gains, up to 50 rupees lakhs, in specified bonds within 6 months. This would enable her to save on LTCG tax. Thanks for watching.